Good morning, traders. Today is the 9th of August. My name is Neville Hornsey, market analyst with YouTrading. And today I'm joined by
Joel Frank, also market analyst for YouTrading.
How are you doing, Joel?
Yeah, I'm good, mate. How are you getting on?
Yeah, very good. Yeah, just avoiding the Englishness of the weather.
I know. It was a bit of a shock, literally, because I flew back from Tenerife yesterday,
Yeah.
taking off. Oh, perfect, beautiful sunshine, not a cloud in the sky. And then just as you cross the English Channel, there's just this like sea of clouds. And I was like, oh no, what am I walking into?
No, it's a very temperamental. I was
Yeah.
out and about yesterday. That was, with the sort of family. And we buy an ice cream because we're sweating and everyone's taking their coats off. And then before you've even eaten your ice cream, we're literally in a downpour. It's just really, really changeable, sort of quite erratic, quite volatile weather. It's
odd.
And I guess if we're going to sort of make a segue into the markets, the gold and dollar moves are erratic, volatile, and unpredictable at the moment.
Well, yeah, gold especially, like, man, that move's just been insane, hasn't it?
Yeah.
I mean, you could, bring it up.
Yeah, just get it on. All right, here we go. I'm going to start with a weekly chart, I think, because obviously a big run up since like last summer, all the way up. Everyone's getting super excited about $2,000 and all that. Gold, $2,000 an ounce gold. We left some support lines back here, and I thought today we were going to test them and actually break below the 16.95. Other than the dollar moves, I don't really know what's going on in the gold market.
Yeah, I mean, so it's just going back to the fundamental side. Obviously, at the end of last week, we had very strong US jobs data. That's probably the way to summarize it, isn't it?
Yeah.
I think it was 938,000 jobs added in the month of July. You also saw positive revisions to the June and May jobs reports. I think June, that put the June rate up to 945,000 jobs added. So, you saw a larger than expected drop in the unemployment rate. And pretty much the way that I've seen most of the market commentators and analysts kind of frame that data is it very much strengthens the argument that the more hawkish FOMC makers have been making. And they've been making this argument that the tapering of QE purchases should happen faster, just in case the Fed does need to start hiking interest rates, in the middle of next year or at the end of next year. Obviously, that is hawkish then, isn't it? So we've seen this hawkish reaction in markets. We saw upside in bond yields, upside in the dollar, and downside in gold, because obviously gold doesn't like a hawkish Fed. But this move has been way bigger in gold than it was in the dollar. I mean, I'm sure we'll look at a dollar chart in a second. But I don't know. But how come you think the move was so much bigger in gold than the dollar?
Honestly, I don't know. The thing is, because we've got this area balance here from the May the 20th, 2020, that obviously acted as support again in March 2021. Then we had this rise up on expectations and then a drop back down, then that grind, and then another drop back. But we've only gone back down to the previous support that was, like I just mentioned, like 2020, 2021. So if they had actually taken the stops underneath there today, I could say, it's just a liquidity grab. It was just, like the algos and everyone just grabbing as much liquidity as they could to go higher. But because they haven't done that, I still think there's buyers. There's buyers down here, and whether that's the producers or not, I do not know. But at some point, I think it's just all down to the dollar. And the dollar raced up last week by 1%.
I almost feel like with gold, it was almost like the people selling gold almost took it a little bit too far. And we're going to need to see a little bit more dollar strength to warrant gold breaking. There's lows you were just talking about. I think we're going to probably need to see the dollar. What you got this dollar on a daily chart? So we're going to need to see this push on a little bit, I think.
Yeah, but I don't, because last week, let's just go back to my analysis last week, on the euro, because that's how I was playing the dollar last week. I said I'd like to see this continuation of the breakdown, the retest of the old support, then carry on down, and then these lows here would be where they would target for, because I couldn't see them going like all the way back down, like to 1.15 in just one move. I thought there'd be like stages to this.
Yeah.
So I got down to my target on Friday, which is great. Nice. But then everyone's sort of caught short. Everyone's short now, aren't they? It was a surprise on NFP. It was like Angie's like say all the high revisions. So everyone's thinking definitely going to be a hawkish Fed. But then you look at the participation rate of employment, and it's still like 1978 sort of levels. There's still a lot of people looking for work, a lot of people offering work, but the unemployment itself is, the participation rate is still really low. So I think the move was so big based on the headline move, like in terms of NFP is brilliant, revisions are great, big move up in the dollar, only to go into this sort of balance area from like late July. If we had pushed higher and taken the liquidity and then come down, I could say, okay, great. They just took that bit. But, it's stalled here now. And
okay. So you're not quite ready to buy on dips just yet.
I just think I think Friday was very emotional. That's what I think. I think Friday was very emotional. And now everyone's thinking lots of positive things about the US dollar.
Yeah.
And like you say, gold, I think gold is kind of like a hedge against inflation expectations. Yeah. And also when the Fed policy is wrong.
Yeah.
And I think personally, we broke out of this rising channel on gold last week because of the dollar move. And then, maybe I just wish they had taken out the lows from, like March 2021. I
think they will. I think we're just going to have to be a bit more patient. Like you're saying about how these moves happen. You were expecting them to happen in stages, the move lower in euro dollar. I think you got to think that that's going to be the same for gold. Like personally, after that NFP, I'm expecting Fed members potentially to sound a bit more hawkish this week. Which
I think they're going to try and wind it back because they saw the reaction, didn't they? It's a really big emotional reaction, and now I think they're going to be like, oh, they don't
I don't know, but I think some of them that's what they want to see. Maybe that's what some of them want to see.
I think they like it moving slowly and smoothly. They like to be in control. If they see like big moves, because it only takes so for me, big impulsive move, correction down, and then like an impulsive move, and then we've had like this 3 move down now. But they didn't take the stop, so that they're still there. So everyone's like still worried that they're going to do that. But then there's like this support level back down at 1,450. So there's like space to the downside. This area down here from like 2016 all the way across to 2019. That's the sort of real sort of floor. That's where the majority of buying would have been taking place. And then we've just had this reflation trade, this expectations of hawkishness. It's just, I don't trust the markets at the moment. Because I think everyone's quite emotional and expectations are quite high on lots of things to happen.
Yeah, true. I don't know. Maybe I've been caught up in all the emotion, but I think that there's going to be a continued steady grind to the upside in the dollar and in potentially in yields as well. And so that informs my view on gold that we will eventually break below that level you're talking about. Yeah. And then as we go through that level, man, like you said, there's this big sort of gap in terms of the technicals. So we could see a move like what we saw today, to be honest.
But that means if we did do that, then that means dollar's going to take out all these swing highs. But I don't see.
Yeah. You don't see that happening.
Well, I don't understand nothing's actually happened that's different today than it was, at the start of the year. Like the interest rates are still really low. The trade balance is really high. QE is still going on, whether or not they raise rates or not. I think.
Do you know what I think? What I think is this: with every fresh, strong US jobs data, you move one step closer towards a Fed that's normalizing monetary policy. And you've got to remember with the dollar index, the biggest two components of that is euro dollar and dollar yen. And if you look at the ECB and the BOJ,
Yeah,
neither of them are moving towards tightening. I mean, the BOJ is never going to tighten monetary policy again, and the ECB might not ever either. Like, they're so far behind the Fed. It's like they haven't.
But you could even say that
started.
about the Bank of England, because they were saying like they would taper at 0.5%. They would, start selling stuff at 1%, and then everyone was like, well, that's never going to happen then. Just like we're not going to like 1% interest rates in the in like the foreseeable future. Like,
I don't know. I think the Bank of England's got a better chance than the ECB and the BOJ, because like inflation is, I mean, for the Bank of England, it's gonna rest on inflation. Really, they're not as obsessed with the employment rate as we are in the UK. They're more focused on inflation. So yeah, you could be right. Like, inflation could disappoint in the UK. That wouldn't surprise me.
I think like the central banks are going to disappoint. I think RBNZ have probably got themselves into a corner where they probably feel like they have to now. Bank of Canada probably will. What'd you say, like the Norges Bank? They're probably,
Norges Bank will,
probably will.
I mean, Norges Bank, for the Norges Bank and the RBNZ, they're not really saying it, but they're scared about house prices pretty much.
Yeah. And I think the Fed, I mean, again, maybe it's slightly tin hat stuff, but Fed Chair Powell is probably the most powerful central banker in the whole wide world. Like, he is like a human man, and he's probably got an ego, and he probably enjoys being that person, and he probably doesn't really want to rock the boat and have President Biden say, "Why did you mess up the economy right now?" So this whole FOMC substantial improvement, they want to see this amorphous thing happen, and they don't give you any specifics, so they can just keep. It's like the war on inflation. It's like you're never going to beat it. Like, it's just they're not giving any specifics, and I think that's just to try and like tease out the market, which is why we probably get these big moves on what we perceive to be like substantial progression and things like that. It's just I think the Fed's just going to tease, because the participation rate and the transitory inflation is probably all going to make them feel it's still not ready. So I don't know.
Possibly. I mean, this is well, I mean, that's a good argument as why you would still want to be long gold, to be honest. Yeah. Although, I mean, in this kind of choppiness, just looking at that chart makes you not want to be long gold, to be honest.
No, but
I know what you mean.
But if we go to gold and we say, how do you trade gold? I think you look for anywhere where it went sideways or grinded higher or lower. So like this little box here, that's where you start looking for buys. When it gets back up into this grind higher here, that's where you look for a sell. If it pushes through that sell, then you look for the next box, which is that bit up there, like 1900. If it gets through that box, then you're looking down here to this like little pause in the market. You just don't want to be caught trying to go short, and it like just takes liquidity and runs up. Yeah, you want to sort of see your idea and have a bit of space. Yeah, just in between, because it can reverse at any of these sort of consolidation sort of balance areas, and then just obviously just do a 180 within a few hours. Just take a couple of percent of your account away.
I mean, gold is a heavily traded commodity, but compared to like FX markets and bond markets, it is thinner conditions, isn't it? Which is, I guess, how you can see these moves. And also, I guess at the start, like we were also saying, it's summer conditions, isn't it? And sort of liquidity tends to be a lot thinner at this time of year.
Yeah.
So man, gold.
So like,
what else are you looking at?
So long bonds, the TLT ETF, if they do come down because interest rates, perceived to be going higher and yields are going to go higher, then again, I think we need to be sort of careful of where prices are broken out before old resistance becomes support. So we're just looking for those sort of as targets, and I think that will sort of
I like that
pave the way. Euro versus US dollar, I think you just need to keep playing whatever the market's has been doing.
It's going to keep taking their direction from the dollar, aren't they?
Yeah, but if it is like dropping and then going sideways, you don't look for a long, you look for a breakdown, a retest, a continuation to the downside until you start taking out previous highs and things like that. But also I was thinking the tech stocks, the Nasdaq, they were following the same pattern as the euro and the opposite of the dollar, and they've done a gold and reversed like today. So I don't know what that says about the markets either. I don't know if the US 500 is going to drag the Nasdaq up along with the Dow, but you know, it made sense when the euro was coming down and the Nasdaq was coming down, and now the euro's kind of stopped, the gold reversed, and Nasdaq's gone higher. So
yeah. I mean, stocks are a weird one, aren't they? Like Nasdaq is also quite vulnerable to long-term US bond yields. So that's one to watch. If yields are moving higher, then the Nasdaq, not saying it's going to have a big sell-off, but it's going to probably underperform the rest of the US stock market.
yeah,
the S&P 500, it's also a little bit vulnerable to a rise in bond yields. But the thing is, a lot of the stocks that make up the S&P 500 are those cyclical stocks that like strong economic conditions. So yeah, it's almost that balance between good economy, good for stocks, but what if the economy is so strong that the Fed becomes really hawkish, and then is that bad for stocks? And this is the balance we're still trying to play with stocks. And yeah, I mean, it is going to be a bumpy ride going ahead as the Fed moves towards tapering.
Yeah, and also like I think there's been a realization as well that people do not necessarily want to go to work in an office or to a low-paid job, and the tech stocks obviously benefit from people staying at home.
Yeah.
So if that is now the new normal, where there's more of that stay at home, yeah, I was reading a report where they said like 50% of people would take like the sort of holiday pay cut, or they would work some extra hours so they could work at home, or take a sort of benefits cuts, like their sort of health insurance.
Yeah, they at least want flexibility, don't they? Like they want 2 days a week at home or something like that. Yeah.
So yeah, the tech stocks are going to be, riding on that, because more people at home, the more people watching Netflix, more people using Zoom, all that type of stuff. Yes, and our 20, 50, and 200 period moving averages on the daily S&P. Unfortunately, we didn't get to test those last week. Otherwise, that would have been a great buying opportunity. But that's just still grinding higher. Aussie and New Zealand were strong last week, and it's quite interesting that they're now weak. They got weak at the end of last week, and they're still weak now. So that makes sense, I guess.
Yeah, I mean, the Aussie, they're both kind of vulnerable to, obviously there's this concern about these coronavirus infections and lockdowns in China. They're both vulnerable to that because it's an important trade partner. But the Kiwi does, if the RBNZ is going to hike on I believe it's the 18th of August, that should mean that the Kiwi at least outperforms the Aussie. Doesn't mean it's going to be higher against the dollar, but I suspect it won't fall as much as the Aussie against the dollar.
Yeah, because the Kiwis trend is to the downside. We've had impulsive move down, grind higher, then sideways, then down, then sideways.
Yeah,
so it's going to take a while before traders really think that this is a positive thing.
Yeah, I mean, the only reason it hasn't, that sideways over the last 2 months, the reason that's been happening is because the RBNZ's hawkishness has stopped it falling.
Yeah.
I mean, if you look at the Aussie, it's continued trending lower, hasn't it?
Yeah. Aussie's still got some good targets to the downside. I'm a real believer in this double bottom scenario. I think that's where a lot of traders start looking. Once we start getting underneath big moving averages like the daily 200 moving average, they go, well, where is the next sort of set of places to buy? And I think, back down here. And it's a big level, 0.7. So it's the big figure. And the calendar is not really helpful, is it, this week? We've got Wednesday USD CPI, but the Fed look at PCE. So
they do, but they do look at they don't use CPI in their sort of final decision making, but they do definitely take note of it. Like when we first hit 5%, some of them were like, whoa. So I think, to be honest, the Fed has they're still talking this inflation is transitory narrative, but the longer inflation stays elevated, because most people think the year-on-year rate is still going to be, somewhere in the 5%, somewhere like mid 5%. The longer that continues, the more it undermines their argument, doesn't it? And imagine if the Fed pivots on its stance on inflation and says, do you know what, inflation's higher than we want. That could be the most hawkish thing they could possibly say, pretty much, isn't it?
Yeah, I think, and a lot of times, like, we see market analysts and ourselves sort of trying to predict when they're going to actually raise rates. But as soon as, like you say, as soon as they say something as such strong as that, then the market adjusts almost instantly. So they don't even have to raise the rates, or they just need to say something like, okay, inflation is now too high. Yeah. And the market would adjust almost instantly.
I think it's still too soon for them to say that, though. Like, I think they're still, even if inflation does come up, there's another high in inflation. I think we're probably gonna have to wait until next year before they potentially do that inflation is too high pivot.
Yeah.
But
I mean, because March through till August of 2020 was the sort of period, where these base effects are still sort of playing into the transitory sort of narrative. But come September, that's when, things have not improved, but, got a little bit more normal in 2020 because of lockdowns being eased at certain points. So at some point, it'd be interesting to see when they say the base effects have kind of run their course.
Well, I mean, the base effects I think it's a rubbish argument, to be honest, because if you want to get rid of the base effects, just look at the month-on-month increase in the CPI index, and the month-on-month is going at like 0.5% at the moment, isn't it? So it's like inflationary pressures are pretty high. So yeah, I mean, the thing is, they've been putting that down not to base effects but to the reopening, and also some supply bottlenecks and stuff. And it's just a question of if that eases back. And I mean,
well, there hasn't been any easing back of bottlenecks.
There hasn't.
And like I said, like this, tomorrow's like ZEW for German economic sentiment, just based on the factory data last week and all of the sort of earnings reports that we've been hearing. They're saying like the bottlenecks, the employment situation, the supply chain disruptions, the variant, Delta variant is still causing problems, and it doesn't seem to be going away. And I flicked through my phone, and I wish I hadn't, because I just sort of saw Boris Johnson planning for autumn lockdowns. It's like, no, I'm not even.
Oh God, I know. Don't read that.
It's so obvious that it could actually happen. I don't want to sort of, read how.
Don't say that. I refuse to believe it. It's just
exactly.
Newspapers wanting clicks. Newspapers wanting clicks. That's what it is.
I think so too. But that, in terms of sentiment, puts a bit of a downer on things, doesn't it? So
yeah.
But it sort of just reiterates what the CEOs and companies have been saying, that there are still disruptions. It's still hard to get your products in and out of Britain through the ports because of lack of drivers, lack of people actually at work, and the amount of people I've heard in different jobs who have been told to turn the apps off, which would maybe, prevent them from coming to work because there's just a lack of employed people. Yeah. It's quite scary. So
yeah, it's crazy, isn't it?
But economic calendar.
It's dominated by CPI. Also, Fed speak's going to be important to see how they react to the latest strong US jobs data. In terms of other stuff, like UK GDP is probably worth noting. What else we got? I mean, that's the main things. We've got a few bits of data coming out of Australia and New Zealand.
Yeah.
US but nothing
weekly jobs claims will probably be another pivotal thing.
Yeah, that's always a good. That's always a big one.
They want to see that that's still
trending lower.
Trending lower.
Yeah.
But in terms of tier one, it's kind of quite light, isn't it? In terms of like summarizing, I think it's just still quite erratic, isn't it? So be careful.
Yeah.
Yeah. All right. I'll catch you next week then.
Yeah, mate. Have a good one.
All right,
Speak soon.
Care. Bye.
Bye.